way I've always explained this to clients is, let's say you're 40 years old, you have a $100,000 policy and a variable universal life policy, and you're paying $100 a month. The first premium, they ask a question: how much does it cost to insure Mark, happy, healthy, non-smoker Mark, for $100,000 who's 40 years old? The cost of insurance might be $20 a month. And the difference is invested in mutual funds, which is $80. The next year, they ask the same question: what's it cost to insure Mark, who's now 41? And it might be $21 a month, which means the difference invested is $79. There lies your first problem. It's a rising internal cost. It's like a 1-year renewable term based on your future age and what we call the net amount at risk. The net amount at risk is basically your death benefit of 100, let's say, minus the $10,000 of cash value. The net amount at risk is $90,000. If something happens to you, I'm going to deliver a check to your wife for $100,000, but because we're holding $10,000 of your money, the cost of insurance is based on your future age.
Yeah.
And the net amount at
risk. Now, net amount at risk, please understand, our listeners, the risk is to the insurance company there. That's why, we're saying it's a net amount at risk. The insurance company's on the hook for the difference or the delta between
Correct.
your cash value and your death benefit. And you're saying in your research that from last week's episode, 90% plus of these policies were falling apart before the person graduates or passes away.
Correct. And but there's more. So as the cost rises, you reach a point around age 60, depending on the design, where the cost of insurance might equal 100, which is your premium, and no more dollars are invested. And the following year, if your cost increases by only 7%, even though I think it's probably closer to 9 and 10%, if your cost is 107 as a 61-year-old, they have to take that extra $7 a month from your cash value.
It's got to come from somewhere, and you're not paying $107 this month, but it costs that much, so they got to, it's got to come out of the cash value. So I see.
Correct. Mm-hmm. Rule of 72. 72 divided by 7 in this case is 10. That means your cost of insurance theoretically could be $214 at age 71, $428 at age 81, and $856 at age 91.
And you're still putting in, if you can afford it, in your 80s. Maybe you're living off retirement and you're not putting anything into your premiums at this point. So
that means the cash value is eroding. Yeah. You're getting older, the cash value is eroding, your net at risk is rising, and it's a high cost avalanche that you can't take care of.
And hopefully you're thinking, well, wait a minute.